Uh, Good evening, guys. Can you please confirm if the audio and video is clear to everyone? Is the audio and video clear to everyone? Wonderful. Thank you. So today we are going to revise the chapter of group accounts, one of the most important chapters of ACCA FR F7 paper. Right now, before we start the discussion, I have done some analysis of past papers. I just want to show you the analysis, and after that we'll start the discussion of the revision of the financial reporting group accounting chapter. And in this revision session, what are we going to discuss? We'll discuss each and every concept of group accounts. Further, I have analyzed, you can say, around 12 examiner reports. I think yes, 10, 11, 12. Yeah, 12 examiner reports. And from those examiner reports, I have made a list of all the mistakes which examining team has recommended that they have noticed. Okay, so I have made a list of all the mistakes that you could do. I will discuss that as well. So where is that? I'll show it to you. See, avoid these mistakes in group accounting. So these are the mistakes which you can do in the exam, which I have made a list of. Okay, so I'll discuss this as well with you guys. Now further, I will also give you a index or a coverage wherein I will be telling you that what all things you need to ensure that you have in mind when you are studying group accounts. Okay, so these are the topics which you have to cover it off. Okay, not only this one, also I have went through around past papers, all the past papers, and from those past papers, whatever are the important questions, I have identified those important questions and picked them up, and I will discuss it here. See, questions from the examiner report, whatever are the important questions highlighted in the examiner report, I have taken it up. See, September, December 23, I didn't find any. Now see, I have taken up questions from the examiner report, the important ones I have taken up. Okay, so I'll be discussing these with you also. See, there are a lot of questions which I will be discussing with you. So these are the questions where you can get stuck upon. So I'll be discussing these also with you guys. So basically, I believe that this lecture will be a complete comprehensive revision of group accounts. Okay, now if you are watching this lecture and you have not liked this video, that's not fair. Come on guys, all of you, please like this video. Come on, like this video and hit the subscribe button. Yes, it will be here. Okay, but it doesn't mean that you are not you won't be attending it live. You have to attend it live. Okay, that's the reason why every attempt we conduct live revision sessions. Okay, attend it live so that you can interact with me, discuss your queries, discuss your concerns, and then I will be answering all the comments, comments that comes up in the chat box. Okay, now so let us discuss it one by one. All good so far, everyone? Come on guys, tell me, all good so far? Come on, all good so far? Show some energy, guys. Show some energy. I need energetic persons in the class. Okay, now when I did the analysis of the past 8 examiner reports, what I got to know, see, either they are asking, see, in section C, they are asking 2 questions, right? In section C, they are asking 2 questions. Now the 2 questions are, one will be from group and one will be from you can say single entity. Now how they have structured the format, just notice it off. How they have structured the format, just notice. In September, December 2023, the latest paper available with us, they asked group interpretation, plus preparation of single entity financial statements. Now March June 23 again group interpretation plus again preparation of single entity financial statements. In September December 22 interpretation of means it's an interpretation of the single entity financial statements. Now this preparation came from group accounts. So basically what they are doing, they are asking the questions in this combination. Combination number one. Either they will ask interpretation from the group accounts and they will ask preparation of the single entity financial statements, or they will ask interpretation from the single entity financial statements and they will ask you to prepare group financial statements. So the questions will be coming in this format as per my analysis of the examiner reports available with us. Okay, this analysis is done as per the available examiner reports. Okay, now let us start our main topic for the day, that is group accounts. But before that I will show you something. See, though I won't be referring to this file as of now in the class, but I will be sharing this file with you, and I believe that this file will be of immense help for you guys. Now in this file what I have done, I have went through BPP study text, Kaplan study text, ACCA study hub, went through all, okay, BPP essential reading, went through all and made a list of the topics which you need to have command over for the chapter of group accounts. Okay, so now introduction to the groups, console SOFP, console P&L, changes in the group structure, associates, and then theory. And now what I'll show you, the notes which I have made for you guys is exactly in the same order. I'll show it to you. First is introduction to the groups, then comes console SOFP, then comes console P&L, then comes acquisitions and disposals, okay, and then comes associates, and then comes theory. So exactly I have maintained this order. Okay, don't worry, I'll be sharing this note with you in my Telegram group. The link for the Telegram group will be shared in the description box of this video. Okay, and if you don't have this link as of now, so you can search ACCA financial reporting in the Telegram. You will get my Telegram group. There you can join, and after this session I will be sharing these documents with you guys in the Telegram group. Now tell me, all good to go? Shall we start? All good to go? Shall we start the session? Shall we start the revision of group accounts? We will not be in any hurry. Okay, I'll go at my own pace, explaining each and every topic at suitable length to you guys. Okay, we'll discuss each and everything. Now, group accounting part 1, introduction to the groups. Okay, now first of all understand, now when we talk about group accounts, so definitely there are two parties. Generally there are two parties. One party is the investor and the another party is the investee. The investor has done the investment in the investee. Okay, investor has done the investment in the investee. Now this investment that is done by the investor can be of three types. Now the type 1 is less than 20%, which is called as normal investments, which is covered in the scope of IFRS 9 financial instruments. Okay, and now how do we measure these investments? At fair value. Default classification is fair value through P&L, and there is an irrevocable option to measure these investment in equity instruments at FVT OCI, but this option is available only at the time of initial recognition. Okay, now this investment can be in the nature of subsidiary, can be in the nature of associate. Okay, can be in the nature of subsidiary, can be in the nature of associates. Now So it says, the standard says that for a subsidiary to exist, okay, for a subsidiary to exist, there should be a control. There should be a control. And for an associate to exist, there should be significant influence. There should be significant influence. But in the absence of any information given in the question, okay, for our FR syllabus, if nothing is mentioned in the question, then we will assume that if there is any investment of 20% or more, up to 50%, then that's a significant influence and that's an associate. If there is any investment more than 50%, then there is a control and there is a subsidiary. Okay, so this is the presumption if nothing is mentioned. Going forward in this class itself, we'll also discuss what exactly is the meaning of control and what exactly is the meaning of significant influence. Okay, is that clear, everyone? Now, see, we understood that the investments are of three types: normal investment, subsidiary, or associates. Now comes the question, how shall we account for the investments? How shall we account for these investments? And then the question comes up, in which books of account? So now the answer, so again, I'm coming in then the notes. So we discussed the classification of investments. Now, treatment of investment. The investment which the parent company has done in the investee company, how to account for these investments. Okay. Now, so standard says that you have to assess the accounting treatment in the SFS of the parent. SFS means separate financial statements. Now, how will you account for in the separate financial statements of the parent, that the investor? How to account for in the separate financial statements of the investee? How to account for in the group financial statements? Okay, now let us study all these one by one. In the SFS of investor, now tell me, when I am investing in the investee company, what is the journal entry which I'll pass? Generally, what is the entry which I'll pass? So on the date of investment, I will pass investment account debit to bank, and subsequently I will carry these investments at fair value either through P&L or through OCI, right? As per the principles of IFRS 9. But here IAS 27, or I will not take the name of the standards. Okay, rather I'll say the investor company, the investor company can recognize these investments at either fair value or at cost. Okay, this is the option available with the investor. Okay, now how will investee company pass journal entries? Now understand, let's suppose I am purchasing the equity shares of Reliance company. Tell me, what is the journal entry which Reliance company will pass? Can anyone answer? If I am purchasing the equity shares of Reliance, what is the journal entry which Reliance company should pass in its books of account? Then you will say, sir, the entry will be bank account debit to equity share capital. But my dear friend, generally if I am purchasing an equity share of Reliance, I am purchasing it from the market, open market, not from Reliance, right? So if I am purchasing any equity shares of Reliance is unaffected from this. Why? Because I am purchasing it from the shareholders of Reliance. That's the reason why it says in the SFS of investee company there is no treatment. Okay, but if the question specifically mentions, listen to me very carefully, this is the area where you can do mistake. If the question specifically mentions that the investee company has issued the shares, okay, investee companies issued new shares, then we will pass entry, that is bank account debit to equity capital to securities premium. Is that clear to everyone till here? Come on guys, tell me. Is that clear to everyone till here? Come on guys, tell me. बोल दो गाइस, क्लियर है क्या यहां तक? देखो एनर्जी सो होना चाहिए क्लास में। एग्जाम आपका 10 दिन बाद है, आपको एनर्जी दिखाना पड़ेगा क्लास में। मैं यहां पे बाबा जीवन के नहीं आया हूं कि मैं ज्ञान दे रहा हूं, आप लोग सिर्फ सुनोगे। क्लास में एक्टिव रहो, ठीक है? चलो स्टार्ट करते हैं, आगे रिज्यूम करते हैं। अब हमने डिस्कस कर लिया कि इन्वेस्टमेंट्स का अकाउंटिंग ट्रीटमेंट एसएफएस ऑफ इन्वेस्टी में क्या होगा, इन्वेस्टर में क्या होगा। अब बात आता है इन्वेस्ट ग्रुप एफएस में क्या इसका अकाउंटिंग होगा। तो ग्रुप एफएस में पता है हम लोग क्या करते हैं। नाउ द व्हाट विल बी द ट्रीटमेंट इन ग्रुप एफएस। सो इन द ग्रुप एफएस, we will unbox the investments. Now when we do the unboxing of investments, like for example you have received a parcel from Amazon. Now what you do the unboxing. When you do the unboxing, what happens? You get the stuffs inside it, right? Similarly, we are unboxing the investments in the group FS. Now when we are doing the unboxing, we get the assets of subsidiary, we get the liabilities of subsidiary, right? Now we compare, okay, this is what I have got, and this is what I have paid. This is what I have got, the net assets, this is what I have paid, the investments. Okay, now I will compare these two. Any excess is called as goodwill, any shortfall is called as gain on bargain purchase. If I have paid any excess, that excess is called as goodwill. If I have any shortfall, that is called as gain on bargain purchase. Okay, is that clear everyone? See, I have written here. Any excess is goodwill and negative is gain on bargain purchase. Very good, Harpin. Now see, Harmit is too active. He is saying clear hai. Now you have to be like Harmit. Now valuation of costs of investments. अब देखो समझो बात को. Now understand, please understand. Investments in the books of parent company, recognized at cost or at fair value. I believe we have discussed this one. But on the date of acquisition, on the date when the parent company has invested in the subsidiary or the associate company, on that particular date, anyways, we are going to account for the investment at its cost. Now that's the reason why we are required to study how to value the cost of investment. So now what is there in the valuation of cost of investments? That is very much simple. Whatever is the amount that I have paid to acquire these investments is the cost of investments. Agree? But the consideration are not settled in an easy format. They might be settled in the form of cash. They might be settled in the form of shares of the parent company. They might be settled in the form of deferred consideration. They might be settled in the form of contingent consideration. So now we have to understand that in each of these situations, how exactly are we going to deal with it? Okay. Now understand. So cash consideration, first of all, is cash consideration. I have acquired the investment, I paid cash. Now whatever amount of cash I paid is the cost of investment. The entry will become investment account debit to bank. Sorted, clear. If I am issuing the shares, I acquired the shares of your company, and in return I am giving the shares of my own company. Now if I am giving the shares of my own company, that is called as share exchange. Now which has to be recorded at fair value. So you have to calculate number of shares that you have issued, multiplied by what is the fair value per share. Okay, that will be the fair value of the share exchange. So the entry will become investment account debit to share capital to securities premium. Harsita, bargain purchase is recorded in group P&L. Yes, it is recorded in group P&L. We are going to discuss it further. Okay, here I was just giving you a basic essence of what exactly is a journal entry like. Okay, but yes, the accounting treatment of goodwill, the accounting treatment of gain and bargain purchase, we will discuss in depth going forward. Okay, don't worry at all. See, I'll show it to you also. See, goodwill or gain on bargain purchase, I'll discuss it with you. Don't worry. I will discuss whatever you are thinking of. I will discuss whatever you can't even think of. Okay, उसा ना, मैं जो बोलता हूं वो मैं करता हूं, मैं जो नहीं बोलता वो मैं डेफिनेटली करता हूं. Okay, now, so cash consideration done, issue of shares by parent company done. Comes deferred consideration. Now, what is deferred consideration? What is deferred consideration? So, deferred consideration basically means that I have acquired the shares now. I have acquired the shares now, but I will be giving you the purchase consideration after 2 years, after 3 years. Okay, after 2 years or after 3 years might be. Okay, now, so it is the fixed amount of money. Understand right here. It is the fixed amount of money. It is a fixed amount of money. After a fixed period of time, and I'll write it off here properly. Just a minute. Fixed amount, fixed time, and the payment is also certain. You will definitely pay. Okay, so in this case there is no uncertainty of the payment, there is no uncertainty of the amount, there is no uncertainty of the timing. So they are fixed amounts of money to be paid after fixed period of time, and the payment is also certain. So you will have to consider the present value of this deferred consideration. Okay, now whatever is the present value, you will record that as an investment. Okay, I believe that is clear to all of you. Okay, now further, so what you will record? Investments account debit to deferred consideration. But since you have calculated the present value, now you have to do the unwinding. Please remember one thing, जहां present value होगा वहां unwinding होगा. Please remember this point till your last breath. Okay, जहां unwinding होगा, wherever there is unwinding, okay, wherever there is unwinding, wherever there is a present value, there is a unwinding concept. Is that clear, everyone? Is that clear, everyone? So this is also one of the mistakes that you do in the exam. You forget to unwind the deferred consideration going forward. Okay, so please remember always that if there is a deferred consideration, you have to unwind the deferred consideration and record the finance cost. And what is the journal entry of finance cost? Journal entry is finance cost account debit to deferred consideration. Okay, now these deferred consideration will be recognized as a financial liability in SOFP at each year end. Okay, you will recognize in SOFP as financial liability at each year end. Now this financial liability can be current, can be non-current, which you have to evaluate. If it is payable within 12 months, it is current. If it is payable beyond 12 months, it is non-current. So be careful in the exam. For two things. If there is a deferred consideration, be careful in the exam for two things. Point number one, always recognize this at present value. Point number two, always unwind and record finance costs, and always do the correct classification whether it is current or non-current. So please keep these 3 points in mind always. Is that clear, everyone? Now, contingent consideration. Now, what is happening with contingent consideration? So, in the contingent consideration, what happens? The amount is again fixed. The amount is again fixed. The time is again fixed. But what happens here is whether we have to do the payment or not is contingent upon future events. is contingent upon future events. Like for example, if the subsidiary company which we have acquired gives me a profit of this much in the upcoming year, then I will pay you this much. Means I will pay provided this condition is satisfied. Okay, so there is a contingency in the payment. So you have to consider two things: the time value of money, that is the present value concept, and the probability concept. But the examining team has been liberal for FRA students. The examining team has been liberal for FRA students. The examining team says no need to calculate the probability factor, the present value factor for contingent consideration. I will directly give you fair value. I will directly give you fair value. See, the examiner is so considerate. The examiner is so considerate. It's saying, I will directly give you fair value. You consider that fair value and calculate the value of contingent consideration on date of acquisition. Now you will ask me, sir, what if the fair value changes subsequently? Fine. If the fair value changes subsequently, then change the contingent consideration and record this fair value gain or loss in the P&L. Now, will I change the value of investments due to change of fair value? No. Will I change the value of investments due to change of fair value of contingent consideration? No. Tell me, is that clear? Now, this contingent consideration will be recorded as financial liability in SOFP at each year end. Any fair value changes will be recognized in P&L. Is that clear to everyone? Come on, guys, tell me. Okay. Now, acquisition related cost. If the entity has incurred any acquisition related costs, that will be recognized in P&L. Come what come may, it will be recognized in P&L. Do not make this mistake that you are capitalizing the acquisition cost to the cost of investment. No, my dear friend, it will be directly recognized in P&L. Okay. Now a quick summary of it. Cash consideration, investments on date of acquisition will be at amount paid, share exchange, fair value of share exchange, deferred consideration, present value of deferred consideration. Subsequently, unwind deferred consideration and record finance costs and pay off deferred consideration on the scheduled date. Contingent consideration at fair value of contingent consideration. Subsequently, record fair value changes in P&L. Okay. Acquisition at cost, transfer it to P&L. Now I have an example for you covering all these points. Now, example. On 1st July 2021, A Limited acquired 60,000 shares of B Limited. Total number of shares is 100,000 shares by paying the following consideration. Cash of $20 per share acquired. Issue of 3 shares of A Limited for every 5 shares acquired. Fair value of share per share of A Limited and B Limited is 12 and 8 respectively. Cash to be paid after 2 years is this much. Discount rate is this much. A Limited will pay itna in cash after 3 years if EPS of the combined entity, there is a condition. Okay. Fair value of this consideration is 12,000 and on 31st March 2021 is 13,500. Okay. Calculate the purchase consideration. Or calculate the cost of investments, you can say. Okay. Now, what is the cash consideration? 20 per share. How many shares? 60%, 60,000 shares. So 60,000 multiplied 20 is 1.2 million. Now, further, issue of 3 shares for every 5 shares acquired. How many shares I have acquired? 60,000. 60,000 shares I have acquired. So now I will issue 3 shares for every 5 shares acquired. So 60,000 into 3 by 5. Now what is the fair value of the shares that I am issuing? I am issuing my shares. A Limited is issuing its own shares. So what is the fair value of A Limited? 12 per share. So multiplied by 12 per share is this much is the fair value of share exchange. Now what is the cash? So it says cash to be paid 50,000 fixed amount of money after a fixed period of time, and the payment is also certain. There is no condition attached. So I will calculate present value of it at the rate of 10% per annum for 2 years, which comes to 41322. Now, further, A Limited will pay 30,000 fixed amount of money after a fixed period of time, but the payment is dependent on some future events. Okay, this is the future event. Now, hence, we will consider the fair value on the date of acquisition, which is fair value on the date of acquisition is 12,000. So I will consider 12,000. So adding all these four, you will get the value of purchase consideration or the value of investments on the date of acquisition. Harshita has a query. Sir, if both CPL and CFS is asked in, we must deduct cost of acquisition from CRE and not add to operating expense of CPL. Okay. If CPL and SOFP both is asked in the exam, okay, console P&L and console SOFP both is asked in the exam, what is the treatment of cost of acquisition? So understand, the cost of acquisition, whatever is incurred, you will recognize that in the P&L. If not recognized, if in SFS they have capitalized to the cost of investment, then you will rectify your investment by passing entry what? P&L account debit to investments by the amount of cost of acquisition. Is that clear, Harshita? So basically we are reducing the cost of investment by the amount of acquisition cost and transferring that amount to P&L. Clear, Harshita? So this is the cost of investments. Now coming on to the sixth point. Okay, let's come to the index little bit. We will see what we have discussed. We have discussed the classification of investments. We have discussed the treatment of investment in SFS of parent, SFS of investee, group SFS, group financial statements, cost of investment also we have discussed. So we have discussed this much. Out of this much, we have discussed this much. Okay, now, and we have spent around 33 minutes. Okay, now moving further. Fair value of net assets. How CC got 12,000? It was given na, the fair value of the contingent consideration on 1st July 2021 is 12,000. 1st July 2021 was the date of acquisition. Okay, now fair value is 12,000. So we recognized it at 12,000. Is that clear, Balaji? Now, fair value of net assets of investee or of subsidiary. So now you know that the net assets of subsidiary are acquired at fair value on the date of acquisition. Okay, so it says all the identifiable assets and liabilities of acquiring company are to be acquired at fair values on date of acquisition, for which we do fair value adjustment. Do you remember that? Can you remember that? Fair value adjustment on the date of acquisition, we do fair value adjustment on date of acquisition in the statement of net assets, fair value adjustment on date of acquisition in the statement of net assets. Can you recall that? Are you able to recall that, guys? Come on, tell me. We have discussed it multiple times in our live lectures. Come on, guys, bolo. Okay, it says further, there can be instances where the assets and liabilities are not recognized in the books of subsidiary in accordance with the applicable standards, like for example brand name, like for example tell me what? Brand name, customer lists, they might not be recognized in the SOFP of investee company, but yes, we can recognize that in the group FS at its fair value on date of acquisition, provided they qualify or they satisfy the recognition principle of IAS 38 intangible assets. Okay. Okay. CRE, that is console RE or the group RE, what exactly it is? It is a form of CPL. The balance of CPL goes to CRE. If you are already preparing CPL and have adjusted the acquisition cost there, okay, now you will take the balance of CPL, that is the profit for the year, the total comprehensive income, to CRE. To CRE. So it means in the CRE, the acquisition cost automatically gets adjusted. Okay, Harshita? Now, what is the meaning of non-controlling interest? So, non-controlling interest basically means they are the parties who have interest in my investee, but they don't control the investee. Because I am controlling that investee. Let's suppose I have a subsidiary in which I am having 80% stake, 80% holding. 80% shares are held by me and someone else is holding 20%. Now tell me, who is having the control? I am having the control. Can control be in percentage term? No. The answer for control is either yes or no. The control cannot be in percentages. For the chapter of group accounting, the control cannot be in percentage. Control answer can be yes or no, irrespective of whatever percentage holding you have. Even for 55% you have control, even for 90% control, 90% holding you have control, even for 100% holding you have control. Okay, so control answer can be yes or can be no. It cannot be in percentage terms. The answer for control cannot be in percentage terms. Now let's suppose if I have 70% holding in any company and I have control. So now the person who's having the 30%, is he having the control? No, he is not having the control, but he is having the interest. That's why that person is called as non-controlling interest. That's why that person is called as non-controlling interest. Now this non-controlling interest can be measured using two methods, either at fair value method or at proportionate share method. Sir, which method to follow in the exam? The question will specify that. If the question is silent, then use proportionate share method. If the question is silent, then use proportionate share method. Is that clear, everyone? Now, how to calculate fair value? Ideally, the question will give you the fair value. Of NCI on date of acquisition. Why to calculate NCI? Because if I am acquiring the subsidiary and some other party is having ownership interest in that company, I have to do the accounting for that as well, right, Vishnupriya? Okay, now so basically it says fair value of NCI will ideally be given in the question. If it is not given in the question, then you can calculate the fair value of NCI by number of shares. Just see what is the number of shares held by NCI. Multiplied by what is the fair value per share of the subsidiary company. That will give you the fair value of NCI. Proportionate share method is very much simple. What is the fair value of net assets multiplied by what is the NCI holding percentage? Okay, that will give you the proportionate share method NCI. Okay, student have done a mistake in the exam. Alert point, mistake point, guys. Please, I am talking about a mistake which students does in the exam. Please be alert now. So whenever I say alert, understand that this is a mistake point. Okay, now alert point. What a student does is they take the fair value of net assets of subsidiary, multiply that with the NCI holding percentage, and they say that this is the fair value of NCI on date of acquisition. No, my dear friend. Just because you have taken the fair value of net assets doesn't mean it is a fair value of NCI. No. Fair value of NCI is different. So ideally the question will give you the fair value of NCI. If not given the fair value of NCI and the question is asking that the NCI is at fair value, then in that case you have to take the number of shares held by NCI multiplied by the fair value per share of the subsidiary company. Okay, that will give you the fair value of NCI. Now, proportionate share method, how to calculate the value of NCI as per proportionate share method? Fair value of net assets multiplied by the NCI holding percentages. Okay, now understand, NCI has to be shown as a separate line item in equity. NCI has to be shown as a separate line item in equity. This can come in your section A question or a section B question. Okay, this can come in your section A or section B question, and this will also be helpful while preparing the console SOFP, group SOFP, the presentation marks. Okay, you have to present NCI as a separate line item, in equity. Okay, so the line items are equity, other equity, then NCI, equity, other equity, then NCI. Okay, in equity there are three items: equity capital, other equity, and then NCI, non controlling interest. Sir, can we write NCI in the exam rather than non controlling interest? Yes, you can write NCI as well. Okay, now goodwill or gain on bargain purchase. Goodwill or gain on bargain purchase. But before that, tell me, is that clear to everyone till here? Is that clear to everyone till here? आर यू एंजॉइंग द सेशन? मजा आ रहा है क्या पढ़ के? फटाफट बताओ तो, मजा आ रहा है क्या पढ़ के? समझ में आ रहा है सब कुछ? सब कुछ समझ में आ रहा है? मजा आ रहा है पढ़ के? चलो, गुड. Goodwill or gain on bargain purchase. Can you repeat NCI fair value method? Understand, NCI fair value method basically क्या होता है? NCI fair value method आपको क्वेश्चन में दिया हुआ होगा, नहीं दिया हुआ है तो नंबर ऑफ शेयर्स मल्टीप्लाइड बाय फेयर वैल्यू कर लो, आपको आ जाएगा. ठीक है. गुडविल और गेन ऑन बार्गेन परचेज. नाउ गुडविल कैसे निकालते हैं? परचेज कंसिडरेशन जो हमने डिस्कस किया, दैट इज इन्वेस्टमेंट्स प्लस उसमें ऐड करो एनसीआई, आइदर एट फेयर वैल्यू या प्रोपोर्शनेट शेयर मेथड. क्वेश्चन जो भी बोल रहा है उस हिसाब से आप इसको एनसीआई ले लो, माइनस फेयर वैल्यू ऑफ नेट एसेट्स ऑन डेट ऑफ एक्विजिशन. अब बात आया, सर आपने अभी तो बताया कि हमें गुडविल और गेन ऑन बार्गेन परचेज निकालने के लिए कंपेयर करना होगा, हमें क्या मिला और हमने क्या दिया. अब यहां पे एनसीआई क्यों आया है? व्हाई एनसीआई इज कमिंग अप हियर? Why is NCI coming up here? So understand, logic number one. First of all, to calculate goodwill or gain on bargain purchase, you just see what you have got, the net assets, and what you have given, the investments. Okay, difference between two is either goodwill or gain on bargain purchase. But now understand, you are getting the control over the entire subsidiary. So you are getting the 100% of net assets. And let's suppose you have done investment to the tune of 80%. Now, will that be logical to compare 100% of net assets with 80% of investment? Is that logical? No. So what we do, this investment we have to compensate. So what we do, we add the 20% NCI. Now that's a balance. Now we can compare. Okay, now we can compare. Now when we compare the investments plus NCI, okay, with the net assets, we get goodwill or gain on bargain purchase. Again, NCI can be at fair value method or proportionate share method. Okay, now you know what? Examiner can confuse you. How can examiner confuse you? Rather than writing NCI at fair value, the examiner will say full goodwill method. Entity has a policy of full goodwill method. Now you will scratch your head, sir ये तो आपने बताया ही नहीं full goodwill method क्या होता है. अरे बच्चों, full goodwill method और कुछ नहीं, it's nothing, it's fair value method. देखो, again I am giving you one hint. ठीक है, इस हिंट का गलत फायदा मत उठाना. F for fair, F for full, P for proportionate, P for partial. बताओ अब याद रहेगा क्या? F for अगर if NCI is at fair value method, it is full goodwill concept. Okay, if NCI is at proportionate share method, it is partial goodwill concept. Is that clear everyone? अब तो नहीं भूलोगे एग्जाम में. Okay, now understand. Journal entry will be, you have got the assets of subsidiary, I have got the liabilities of subsidiary, I have got NCI, right? I have de-recognized the investments, I have de-recognized the investments. See, this is what I have got, this is what I have got, this is what I have paid, this is what I have paid. The differential can either be goodwill or gain on bargain purchase. Okay, now gain on bargain purchase, if it is goodwill, definitely you will record that under non-current assets. If goodwill comes, if the outcome is goodwill, definitely you will record under non-current assets below property, plant and equipment. But if the outcome is gain on bargain purchase, then now tell me one thing. I have a company, you know what? I have a company that's $1,000 company. Okay, $1,000 million company, not $1,000 company, $1,000 million company. I am the owner of $1,000 million company. Now tell me, will I be willing to sell that company for $980 million? Will I sell that company for $980 million? Ideally, tell me. Will I sell my company at a loss? Ideally, no. Ideally, no. Right? So standard says that if there is a case of gain on bargain purchase, I believe you have made some mistake in the calculation. So please review your calculations. Okay, there might be some errors. Harshita, that's what I'm explaining. Gain on bargain purchase means I have sold my company at for cheap price. My company was worth $1,000 million, but I have sold my company for $980 million. Means I have purchased a company. Which are having the net assets of $1,000 million, but I have purchased it only for 980. Means मैंने सस्ता खरीद लिया, मैंने इस कंपनी को सस्ता खरीद लिया, तो मेरा तो फायदा हो गया ना. Now the standard is saying ideally no one will sell the company sasta. Right? No one will sell the company sasta. So you have made some mistake in your calculations. So standard says that please review. Now there might be some errors. If there are errors, rectify that. Now then, if you conclude no, you have not made an error, actually you have purchased the company sasta. Then it says that this gain on bargain purchase will be recognized in P&L as other income. ये कैसे हो गया? Gain on bargain purchase will be recognized in P&L as other income. Is that clear, everyone? Come on guys, tell me. जोश और होश हाई रहना चाहिए. कंटेंट मैं संभाल लूंगा. आप अपना जोश और होश हाई में रखो. ग्रुप अकाउंटिंग मैं संभाल दूंगा आपके लिए. बताओ यहां तक क्लियर है सबको? आगे बढ़े तो देखो, खेल में हमने पार्ट 1 कंप्लीट कर लिया है. मजा आया क्या? सर इफ यू परचेज्ड इट इन अ लो कॉस्ट, व्हाई इट इज नेगेटिव? Okay, Aniket, understand. My dear friend, a company you have purchased, let's suppose, for 980, but the company had net assets of 1000, right? So it becomes negative goodwill, right? It becomes negative goodwill, right? 20. Negative goodwill, that's what it is called as gain on bargain purchase. Negative goodwill is called as gain on bargain purchase, which is recognized in P&L as other income. Partial goodwill is also shown in CFS. Understand, Harshita, you are not required to understand partial goodwill or full goodwill. Okay, for now just understand I told you the concept of partial goodwill or full goodwill only for the sake of identifying whether the NCI is at proportionate share method or fair value method. Okay, whatever goodwill you calculate here as per this method is the goodwill which you have to recognize in the console SOFP. Okay, Harshita? Yes, Vishnupriya. Goodwill in SOFP, gain on bargain purchase in P&L. Okay, But which SOFP or which P&L? SFS of parent or group FS? SFS of parent or group FS? We recognize goodwill or gain on bargain purchase in group FS. Goodwill in group SOFP and gain on bargain purchase in group P&L. Okay. Now tell me, is that clear? Can we move forward further? Now let us go to the index. So we have discussed the fair value of net assets. We have discussed about NCI. Okay. We have discussed about goodwill. We have discussed about gain on bargain purchase. Now is the time for console SOFP. Now is the time for console SOFP. Yes, Asita. Yes, Aniket. Yes. If the question is only asking for console SOFP and you are getting gain on bargain purchase, add this gain on bargain purchase to group retained earnings. Why? Again, the reason is very much simple, because the group retained earnings, we we transfer the balance of the group P&L, that is a profit, to group retained earnings. That's all. Now coming to part number 2, group accounting, console SOFP. Console SOFP. Let's start it off. So what is the procedure? What is the procedure for preparing console SOFP? The procedure is, first of all, understand this is the step which you have to follow in the exam as well. Okay, please make a note of all these steps. Now, first of all, identify the group structure. See what is the date of acquisition, what is the reporting date, what are the balance of reserves on the date of acquisition, what is the percentage that you have acquired, what is the NCI percentage. Just the basic points, make a note of it. Just the basic points, make a note of it. Now, step number 2, calculate or rectify investment. There are many times you will see in the question the investments figure is not recognized in the books of account. So, first of all, you have to record these investments and then prepare the console SOFP or the console P&L as the case may be. Okay, so you might need to record the investments or rectify the investments. Okay, now then prepare allocation of net assets. Basically, you are analyzing that what is the balance of net assets on date of acquisition and what is the profit earned by the subsidiary company after acquisition till reporting date. So you are allocating, you are analyzing the profits, you are analyzing the pre and the post profits of subsidiary. Then calculate NCI on date of acquisition, then calculate goodwill on date of acquisition. At each reporting date, calculate goodwill. Sir, goodwill on date of acquisition and goodwill on reporting date ideally should be the same. Then why are you asking for 2 times? Now, goodwill on date of acquisition and goodwill on reporting date might change due to one reason, that is called as impairment of goodwill. That is called as impairment of goodwill. Okay, so there might be instances of impairment of goodwill, due to which the values of goodwill might change from date of acquisition to reporting date. Then calculate the NCI balance on reporting date. Then calculate consolidated other equity, or it is also called as group retained earnings. Okay, then prepare console SOFP. I believe it is clear to everyone till here. I believe it is clear to everyone so far. Now, this was the process that you have to follow. This is the process that you have to follow to prepare console SOFP. Okay. Now, we will discuss each of them one by one. We'll discuss each of them one by one. Step number 1. Read the question and identify. This is very much clear. You have to identify the date of acquisition, the reporting date, the balance of retained earnings on the date of acquisition, the balance of net assets on date of acquisition, the percentage acquired, the date of acquisition, the reporting date, all the basic things you have to identify. Step number 1. Step number 2, calculate or rectify investments. We have already studied how to value the investments. Step number 3, prepare allocation of net assets. That is analyzing the net assets of subsidiary company. Analyzing the net assets of subsidiary company. Now how to analyze the net assets of subsidiary company. So this is the process of allocating the net assets of subsidiary company. So what you have to do is you have to write what was the share capital on date of acquisition. Now the question will give you the share capital on reporting date, and the question will be silent about share capital. It means there is no issue of shares in the post acquisition period. If there is any issue, make a note of it and identify the share capital on date of acquisition. Okay. Now other equity, the question might give you this data. Then now you have to calculate this data. It means this is the post acquisition profit. This is the post acquisition profits. Okay. Now this data will be given in the question. Ideally, it will be given in the question in multiple formats, but it will be given in the question. Now, from here, understand, fair value adjustment on date of acquisition. The question will give you what is the carrying amount of net assets of subsidiary, what is the fair value of net assets of subsidiary. Okay, carrying amount of net assets of subsidiary and fair value of net assets of subsidiary, whatever is the difference is you have to adjust on date of acquisition. So all the fair value adjustment has to be done on date of acquisition. Okay, now if there is a fair value adjustment done, then there is a consequential impact of that. There is a consequential impact of it. Okay, there is a consequential impact of it. Sir, what is a consequential impact? The consequential impact, point number one, if you have recognized fair value adjustment on account of any non-current asset, then you have to record excess depreciation. If you have recognized fair value adjustment on account of any inventory, and that inventory gets sold subsequently, listen to me carefully, alert point. If you have recognized fair value adjustment on inventory on date of acquisition, then and subsequently in the post period the inventory gets sold, to the extent the inventory got sold, you have to reverse the fair value adjustment. Let's suppose you have recorded a fair value adjustment on inventory to the extent of 100 here. Now 60% of the inventory got sold, so you have to reverse 60 in here. Be careful. Generally student tends to forget this point. Okay, now unrealized profit. Again, understand. Unrealized profit. So for unrealized profit, understand, when the parent company sells to the subsidiary company, who is earning the profit? Parent company. So do we need to change the profits of subsidiary for that? No. If subsidiary company has sold to parent company, then who has earned the profit? Subsidiary company. Whose allocation we are doing? Subsidiary company. So we have to reverse the unrealized profit of that. If the subsidiary company sells to parent company, see here I have highlighted it. If the subsidiary company sells to parent, yes, we will do it off. But if the parent company selling to subsidiary, no, we will not adjust it here. Is that clear, everyone? Tell me, guys, is that clear, everyone? Okay, now this fair value of net assets on date of acquisition, will be used to calculate goodwill. This post acquisition profits will be allocated to parent and NCI in the ratio of their holding. Post acquisition profits will be allocated to parent and NCI in the ratio of their holding. Is that clear, everyone? So this is the main area where you can make a mistake in console SOFP. Now, so what I am doing here is I will be discussing each of these points in depth now. See, first is the fair value adjustment, second is the consequential impact of fair value adjustment, intra-group trading, intra-group transfer of non-current assets, finance income, finance costs, contra adjustments, dividend adjustment, goodwill impairment. So Miss Sonali, so basically what I was telling, fair value adjustment on date of acquisition, whatever is the fair value of the net assets on date of acquisition, over and above its carrying amount. Let's suppose the carrying amount was 100 and fair value is 120, then you have to add 20 here, okay? So fair value adjustment, the fair value over and above its carrying amount is called as fair value adjustment, okay? That's what you have to add or reduce from date of acquisition. Now, fair value of net assets. So standard says that all the assets and liabilities of subsidiary company are to be recognized at its fair value on date of acquisition. But there are certain exceptions. URP is adjusted in both the cost of sales and Harshita, I'll come to your query. So now see, all the adjustments I will discuss now from the point of view of SOFP, and then I will discuss it from the point of view of console P&L. Okay, I will discuss from both perspective, Harshita. Okay, so your query will get addressed here. Don't worry. Your query is unrealized profit. See, unrealized profit I have considered here. Don't worry. I told no, whatever you are thinking of, I will discuss that. Whatever you can't even think of, I will discuss that too in this class. I promise that. Okay, now just you have to be with me in the class till the end, and I promise that this session will be one of the best session for you for group accounting. Now, intangible assets. So intangible assets, see, understand, generally it says that whatever are the net assets of subsidiary on date of acquisition, I will acquire at its fair value on date of acquisition. But there are some intangible assets which the subsidiary company itself has not recognized, like for example brand name, like for example customer lists. Okay, now standard says that if the recognition principle of intangible assets gets satisfied now, then the group FS we can recognize. Now tell me why we didn't recognize brand name or customer list. Is it the case that this doesn't have any future economic benefits? No, these intangible assets in the nature of brand name, customer list have future economic benefits, but it didn't have any cost, and that's the reason why we didn't recognize these in the SFS of the acquiring company, SFS of the subsidiary company. But when the parent company acquires the subsidiary company, so parent company is paying for that brand name, parent company is paying for that customer list. Okay, also research cost, very good Harshita, research cost also. So all these things will be recognized at fair value on date of acquisition. But for research cost, I will say only one thing. Research cost will be recognized at fair value on date of acquisition if acquirer company, that is a parent company, has value from that research. Okay. Now, research cost also. Okay. Now, any research cost incurred by the subsidiary company after date of acquisition will go to P&L. Till date of acquisition can only be capitalized at fair value on date of acquisition, but any research cost incurred by subsidiary company after date of acquisition will be recognized in P&L. Reacquired rights, you can ignore it off. Sorry, that you can ignore. Contingent liability. Now, whatever is the contingent liability in the books of subsidiary company will be recognized again at fair value on date of acquisition. If there is an indemnification asset, that also will be recognized at its fair value on date of acquisition. Non-current assets held for sale, that is IFRS 5, will also be recognized at fair value less cost to sell. Understand this point. Non-current asset held for sale will not be recognized at fair value, rather it is recognized at fair value less cost to sell. Now the standard tells you one point here. The standard tells, let's suppose subsidiary company has a mic. Subsidiary company had this mic. Subsidiary company wanted to dispose of this mic because subsidiary company didn't had any use of this mic. So subsidiary company was recognizing this mic at fair value less cost to disposal. But the group company, after acquisition, it says that this mic is of some worth. And now it is no more held for disposal for me. So then I will record at fair value. But if it is still continues to be held for sale, then I will recognize that non-current assets at held for sale at fair value minus cost of disposal. So be very careful what is the question asking for. Be very careful what the question is asking for. Is that clear, everyone? Now, consequential impact. So whatever fair value adjustment you have done. So now understand, if you have increased the value, you have to increase the depreciation also, right? So if you have increased the fair value of PP, you have to record excess depreciation in the post period. You have to record excess depreciation in the post period. If you have recorded fair value on inventory, then to the extent inventory gets sold, reverse the fair value adjustment, reverse the fair value adjustment in the post period, in the post period, in the post period, in the post period. Okay, now intra group trading, intra group trading, intra group trading. Okay, now what is the meaning of intra group trading? So basically trading within the group, trading within the group. Now if any trading is done within the group, then we eliminate the unrealized profit. Now how to calculate the unrealized profit? So we see what is the goods remaining unsold, what is the goods remaining unsold, and what was the profit charged by the, and what was the profit charged by the seller company, what was the profit charged by the seller company, what was the profit charged by the seller company. Now considering this fact in mind, considering this fact in mind, now you have to calculate the unrealized profit. Now when you are calculating the unrealized profit, how goods lying unsold multiplied by the profit percentages, multiplied by the profit percentages, this will give you the unrealized profit, but the treatment will be different. Understand, if the parent company sells to subsidiary, if the parent company sells to subsidiary company, then in that case you have to reverse the profit of the parent and reduce the inventory, because parent has recognized the profit. So you have to reverse the profits of the parent and reduce the inventory. Journal entry being group RE account debit to inventory. But if the subsidiary company is selling to parent company, then you have to reverse the profits of the subsidiary and reduce the value of inventory. Now where is the profits of subsidiary going? Post acquisition profits of subsidiary, right? Post acquisition profits of subsidiary to inventory, to inventory. So this is what you have to do. This is what you have to do. This is what you have to do. I believe it is very much clear to all of you. The journal entry is very much clear to all of you. Harshita, I believe this clears your query. Harshita, I believe this clears your query. Now, when you record the post acquisition, this goes to two places. From post acquisition, see, if anything that goes to post acquisition comes up here and is allocated to parent and NCI, right? So if you are transferring to the post period, it will automatically transfer to two places, group RE and NCI, in the ratio of their holding, in the ratio of their holding. I believe it is very much clear to all of you till here. So this is the treatment of intra group trading. But understand one mistake. Alert point, alert point, alert point, alert point. When you are calculating unrealized profit, when you are calculating unrealized profit, so in that case, if okay, Harshita, I'll come to that question also, don't worry. If when you are calculating unrealized profit, the question can say markup or margin. So you might ignore this word. Oh, markup, margin, profit percentage. No, it does have a relevance. Markup means on cost. Margin means on selling price. Markup means on cost. Margin means on selling price. Listen to me carefully. I'm discussing one point. I'm discussing one very relevant point here. Please understand, guys. So let's suppose parent has sold the goods to subsidiary company. Parent has sold the goods to subsidiary company. Now parent has sold a goods of $1,000 to subsidiary company, out of which subsidiary company has sold 60% of goods and the 40% of the goods are lying with the subsidiary company, meaning 400 goods worth 400 is lying with the subsidiary company. Now case 1, parent has charged a markup of 20%. Then what is the calculation of unrealized profit? So the unrealized profit will be 400. Now tell me, we are calculating the profit from perspective of P or S. This profit was recognized by P, right? So we are calculating the profit from the perspective of P. Now from the perspective of P, this 400 is cost price or sale price? It is sale price. It is sale price. So what we have to do? We have to do into 20 by 120. To 20 by 120, right? So 20 is the profit percentage divided by 100 is the cost. So 100 cost plus 20 profit. So cost plus profit is the selling price. So we have calculated the selling price profit. Okay. Now, so this is the unrealized profit. It will be 400 into 20 by 120. That is 67. But if the question tells you margin of 20%, if the question tells you margin of 20%, then what will be the unrealized profit? Then in that case, unrealized profit will be 400 ka 20% is equals to 80. So please be very careful in the exam while reading the term markup or margin. Okay, this was again one of the point mentioned in the examiner report. Now this is intra-group trading. This is intra-group trading. Done. Now comes intra-group transfer of non-current assets. Now, if intra-group transfer of non-current assets, let's suppose I had this mic. Now I sold this mic to my subsidiary company at a profit. Now what happens in that case? Cost plus means. Did I say anywhere about cost plus? Okay. Now, so Aniket, cash in transit will also come here in the question. Don't worry. Vishnu Priya, the question won't come in that. Do you think there is even a single question from that perspective? No, right? नहीं है ना वैसा क्वेश्चन कोई भी. क्वेश्चन सारा सेल पर्सपेक्टिव से दिया हुआ है, राइट? हमारे बुक में जितना भी क्वेश्चन है जो चाहे पास्ट एग्जाम में आया है, सब में सेल पर्सपेक्टिव से दिया है ना, क्योंकि उसने सेल कर दिया तो आपको सेल प्राइस दिया है. और हाँ, अगर कॉस्ट प्राइस दिया हुआ है तो आप वो कर सकते हो, कोई दिक्कत नहीं है. Balaji, there is no such concept from that perspective. Now, intra-group transfer of non-current assets. Now, understand what is the meaning of intra-group transfer of non-currents. Basically, I had an asset which was having a value of $100, but I sold to my subsidiary company at 120. Sold the non-current assets at a profit. Sale of non-current assets at a profit to the group company, to the group companies. Now, in that case, first of all, the person who has sold, let's suppose, if parent has sold to subsidiary, then in the parent books, I will reverse the profit recognized by the parent. How I will recognize? So I will reduce the value of the asset and I will reduce the profit. This is journal entry. Then I'll say, if the profit, if the asset value was 100, but the parent company has earned a profit of 20 and transferred the asset at 120 to subsidiary company. Now, subsidiary company would be charging excess depreciation on $20. Subsidiary company would be charging excess depreciation on the $20. So you have to reverse that excess depreciation. Reversing excess depreciation means increasing the profits. Okay, so you increase the profits and increase the value of non-current asset, reducing the depreciation. Reversing excess depreciation means reducing the depreciation. Reducing depreciation means increasing the value of the asset, and increasing the profits. So this is passed in the books of subsidiary company. Okay, so parent company will record group RE to non-current assets, and for subsidiary company we will record non-current assets account debit to post-taxation profit of assets. Now understand the amount. This one by the amount of profit earned by the parent, and this one by the amount of depreciation charged by subsidiary, excess depreciation charged by subsidiary. Okay, now subsidiary to parent. Harshita, you have a very good question. There is a question also, I think Polestar, North Star, I think you only asked me, right, this question? Subsidiary to subsidiary, Polestar, there is a question in ACCA Study Hub. So now, if it is subsidiary to subsidiary, the concept again remains the same. Post-acquisition profits of transferor subsidiary to non-current assets. Now, here it will be post-acquisition profits of transferee subsidiary to post-acquisition profit of us, right? To non-current assets basically, right? So basically, the logic remains the same. Whether it between subsidiary to subsidiary, subsidiary 1 to subsidiary 2, parent to subsidiary, subsidiary to parent, whatever it is, the logic remains the same. Anything can be asked in the exam, Harsita. Okay, subsidiary to parent. If it is subsidiary to parent, then who has earned the profit? Subsidiary. So I will reverse the profit of subsidiary. Who has charged excess depreciation? Parent. So I will reduce the excess depreciation from the parent books of account. So same logic remains the same. I have discussed this entry. Now intra-group loans. Intra-group loans. Now in case of intra-group loans, understand the finance income and the finance cost will get knocked off from each other. The finance, the loan asset and the loan liability will get knocked off. But there is a very good adjustment of this in console P&L. I will discuss that in console P&L. Okay, I will discuss that in console P&L. But there is a very wonderful adjustment, and also there is a one wonderful question from this perspective in BPP. I will recommend you to solve that question. Question number 169, if I am not wrong. It is 169 only. Let me check and confirm the question. You must solve from this concept. There is a question number 169 or 269. Not 169, 269. Question number 269. It is Spider Company. I will recommend each one of you to solve that question. Okay, it is very good question, and it might confuse you in the exam if you have not solved this question beforehand. Okay, so I will recommend you to solve this question of Spider Company. But let me discuss. I will discuss one concept from the point of view of intra-group loan, but in console P&L I'll discuss. There is a question called Pandar Company. In Kaplan, in your Kaplan material, there is a question called as Pandar Company that covers a wonderful adjustment for intra-group loans from a CPL perspective. Okay, so that I will discuss from the point of view of CPL when I will reach CPL. Now, consolidated SOFP on reporting date. So what you have to do is you have to adjust intra-group trade receivables and trade payables on reporting date. Trade receivables, trade payables, knock off 0. Any difference in trade receivables or trade payables might be due to cash in transit or goods in transit. Let me explain you an example of it. Parent, subsidiary. Parent has a trade receivable of 100K. I'm discussing two situations just for you guys. Please understand. Parent has a trade receivable of 100 and subsidiary has a trade payable of 80. Okay. Now payable to P from S. Now why this situation? Because in this situation what would have happened is subsidiary company would have sent $20 to parent, which parent has not received. So now what will you do in the console SOFP? In trade receivable, trade payables, understand? In console SOFP what exactly you will do? So in trade receivable you will do minus 100, in trade payable you will do minus 80. Whatever is the balances, first of all eliminate it off. Then since this 20 is not received by the parent but is belonging to the group, right? So I will record cash in transit of 20. So now tell me, is the SOFP tallying? The net impact here is 80. The net impact here is 80. It gets tallied. Is that clear, Aniket? Now I will take up one more situation. Parent, subsidiary. Parent has recorded a trade receivable of 120 and subsidiary 100 and subsidiary has recorded a trade payable of 80. Now there might be a case that parent has sent goods has sent goods of $20, which subsidiary company has not received. Which subsidiary company has not received? Yes, cash in transit will be added in cash. Okay. Now, which subsidiary company has not received? So what will you do again in this case? Trade receivables, you will do minus 100. Trade payables, you will do minus 80. And in inventory, you will do plus 20 goods in transit. So again, this is net impact is 80. This is net impact is 80. So this is the concept of cash in transit and goods in transit. I believe it is very much clear to all of you. I believe it is very much clear to all of you. Tell me guys, come on. So this is the elimination. Now loan receivables with loan payables also you eliminate off. Other adjustment, dividend paid by subsidiary. Very good point. Dividend treatment. But before moving on to dividend, tell me guys, is it clear to everyone till here? Is it clear to everyone till here? Anyone having any queries till here? Anyone having any queries till here? I feel that the Joes has went down. Come on guys, show some energy. Come on, come on, come on. Show some energy guys. How's the Joes? How's the Joes? Bolo, hi sir. Is there any subsequent in transit entry? No, Sonali. Okay, no. Now, other adjustments, dividend paid by subsidiary company. Now understand for dividend. For dividend. So for dividend, what happens? Dividend which the subsidiary has given. Parent, subsidiary, NCI. Subsidiary has given dividend to me, to NCI. First of all, tell me, is NCI a part of the group? Is NCI a part of the group? Is NCI a part of the group? Yes, Vishnupriya, I have plans to practice questions today, depending upon if the time is allowing me or not. But yes, I do have plans to practice questions. Is NCI a part of the group? No, NCI is not a part of the group. NCI is not a part of the group. NCI is not a part of the group. Okay. Now understand, subsidiary company has given a dividend of 100. Parent company was having 80% and NCI was having 20%. So parent company would have recorded 80, as in the P&L recorded 80, and NCI company would have recorded 20, right? NCI would have recorded received 20. Now understand, in P&L NCI also would have recognized it in P&L. Now understand please, when we prepare group FS, now parent and subsidiary become one. हम दोनों हैं साथ साथ. Parent and subsidiary become one. हम दोनों हैं साथ साथ. Now can I recognize an income from me? Can I recognize an income from myself? Today I taught myself. So for teaching myself, I paid myself a fees of rupees 10,000. Can that be the case? No, right? I cannot record income from me. So this income of 80 which is recognized has to be eliminated. Okay. Now what is the meaning of NCI? See, we record NCI. What is the meaning of NCI? Tell me, what is the meaning of NCI? Amount that we have to pay to NCI. Though there is no obligation, hence we are recording is in equity, but still it means the amount that we have to pay to NCI. Okay. Now if I have paid a portion of it to NCI, don't you think it will get reduced from NCI? Right? So what is the journal entry? Now, so what I'll record is, I will reduce group RE. Account debit. 80. That is the I will reduce the profit of parent to the tune of dividend received by the parent. Then I will reduce NCI to the tune of 20, because NCI means amount that I have to pay. If I have already paid an amount to NCI, I will reduce NCI to that extent. To to post acquisition profits of subsidiary. Now, when I paid dividend, I would have reduced the post acquisition profits of subsidiary. Now, what I am doing is, now I am reversing the dividend impact. I am knocking off dividend. I am eliminating the dividend. So it will automatically increase the profits of the subsidiary, post acquisition profits of subsidiary. Is that clear, everyone? Is that clear, everyone? Is that clear, everyone? So what is the treatment? What is the treatment of dividend? Parent share of dividend reduced from retained earnings. NCI share of dividend reduced from NCI. Now, in statement of net assets, if the question gives you that this is the amount of profit earned during the year, then no treatment in SOFP, no treatment in statement of net assets. If the question gives you the movement between the retained earnings from date of acquisition to reporting date, listen to me carefully. Alert, 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 alert. Listen to me carefully. If the question gives you, see, there are two things which remains constant and one thing which is which you have to take care of. Two things which remains constant is parent share of dividend reduce. Sonali, that's what I am doing. That's why I said alert point, alert point. Parent share of dividend always reduce from group retained earnings. NCI share of dividend always reduce from NCI. Now, in statement of net assets of subsidiary, please check if the question is giving you the profit for that period, fine, then no treatment in statement of net assets. Okay. But if the question is giving you the movement between date of acquisition till reporting date, then add back the dividend there. Why? Because if the question is giving you the dividend, it means retained earnings on date of acquisition plus profit earned from date of acquisition till reporting date minus dividend is equals to closing retained earnings, right? So dividend is already adjusted there, hence increase the movement. I am repeating again. Dividend has three treatments. Two is constant, one you have to check and then do the treatment. The constant two are reduce parent share from the group RE, reduce NCI share from NCI. These two are constant, always you have to do it off. But in statement of net assets, please check if the question is giving you the profit for that period, okay, profit for that period, then then no treatment of dividend in statement of net assets. If the question is giving you the movement from date of acquisition till reporting date, then add back the dividend in the post period. Okay. Now, Harshita has query. We do this to know the true value of NCI and CRE. Yes, Harshita, only dividend paid to parent is added back to. No. The whole of the dividend paid. See, understand, Harshita, when I am analyzing the statement of net assets here, is it this net assets only parent share? No. Till here, it is the complete net assets of subsidiary. It is here we do the allocation. But till here it is 100%. So you have to add back 100% dividend paid by 100% full dividend paid by subsidiary. Add full dividend paid by subsidiary. Now I will show you through retained earnings account also. Now if you prepare a retained earnings account, what is the opening balance? 100. What is the closing balance? 120. What is the dividend paid? What is the dividend paid? Tell me. 15. Then tell me what is the profit earned in the post period. 135 minus 100 is 35. So that's what I'm doing here, calculating the profit before dividend. What is the profit? Yes, yes, Vartika, very good. Okay, I believe it clears all your queries. Now that's what I have explained. Now dividend paid by parent, there is no treatment, okay, there is no treatment specifically. Why? Because if the parent has paid the dividend, I believe the dividend, it is already adjusted in SFS. But if the question says the dividend paid by parent is not adjusted, then what will you do? You will reduce it from the equity. That's all. You will reduce it from the equity. That's all. Yes, because why in CPL it is only the parent का share? Because in CPL पेरेंट के P&L में तो सिर्फ अपना ही प्रॉफिट लिया होगा ना, तो वो अपना प्रॉफिट एलिमिनेट कर दिया. मैंने ग्रुप आरई में क्या बोला? पेरेंट का शेयर ना. मैंने क्या बोला? ग्रुप आरई में सीपीएल का बैलेंस जाता है. हर्षिता प्लीज अंडरस्टैंड थिंग्स लॉजिकली. Don't try to mug up things now. Okay? So understand. CPL में पेरेंट का PL है, वो पेरेंट का PL है, तो पेरेंट को अपना शेयर ऑफ डिविडेंड मिला था, तो हमें सिर्फ उसको एलिमिनेट करना है. तो वी एलिमिनेट ओनली द पेरेंट शेयर्स ऑफ डिविडेंड. But now here in statement of net assets, we are analyzing the entire assets, net assets of subsidiary. Hence, we have to take the whole of the dividend. That is correct. But in CPL, it's the parent's P&L. Parent will recognize only what he has received. Is that clear, Harshita? Okay. Now, goodwill impairment. If the goodwill is impaired, then you have to assess whether NCI is at fair value or NCI is at proportionate share method. If the NCI is at fair value, the amount of impairment of goodwill will be allocated to parent and NCI in the ratio of their holding. But if NCI is at proportionate share method, then allocate the entire amount of impairment loss to parent only, not to NCI. Is that clear, everyone? Tell me, guys. Come on, tell me. Is that clear, everyone? Is that clear to everyone? Now starts CPL. First of all, come on, guys, please tell me, is it clear, everyone, till here? Are we good to go? Further? Come on, guys, show some energy. Okay, further. Now, starting with console P&L. Again, the approach, first step is the same. First of all, identify the basic concepts. First of all, how we do it in group. Harshita, you are saying we have to allocate impairment loss in parent only. Now, what does it mean? Let's suppose the question will give you the amount of impairment loss of goodwill. Okay. Now, if the NCI is at fair value method, let's suppose guys, this is revision class. I can't take examples of each and everything, but okay, I'll try my level best. Let's suppose goodwill impairment comes out to be 80. Now, if NCI is at fair value method, then you have to allocate it to group RE and NCI, okay, in the ratio of their holding, But if NCI is at proportionate share method, then you have to allocate only to the full amount to be group RE, only 80, nothing to NCI. Okay, Harsita? Now coming on to group P and L. Now in group P and L, step 1 again is read the question carefully and identify the basic things. Okay, that is what is the percentage acquired, what is the date of acquisition, what is the reporting date. Okay, identify all these things carefully. Okay, now step 2. If there are any investments and it is required, then rectify the investments and prepare a statement of net assets if required. See, these two I am writing if it is required. Why? Because there are many a times the question asks you to prepare group P and L, and alongside the question asks you to also calculate goodwill. Now if the question is asking you to calculate goodwill, then you will need these points. If the question is not asking you to calculate goodwill, then these 2 points might not be needed. Okay, now one more point. The question is not asking you to calculate goodwill, but the question is saying that the goodwill is impaired by 20%. Now how will you calculate impairment loss of goodwill without calculating goodwill? So for that also you have to calculate these things. So be careful while reading the questions. Okay, now calculate NCI on date of acquisition, calculate goodwill. If it is required, at each reporting date prepare consol P&L. How? Parent plus S into time adjustment. Now will we do holding percentage here? For each line by line will we multiply by the holding percent of parent? No, my dear friend, no. Parent will take full, subsidiary ka we will do time adjustment, but will not multiply holding percentages. Rather what we will do is parent plus subsidiary ka pura I will take. At the end whatever is the profit comes up, it is then I will allocate that what is for the NCI and what is for the parent. Okay, what is for the parent, this is the allocation which I will show, but for each line by line I will not do the percentage allocation. Okay, now again the same concepts will be repeated here, but from P&L point of view. The same concepts will be repeated here, but from P&L point of view. Guys, come on, don't please continue with the class. I will discuss each and everything again and again. Now everything from P&L perspective. After P&L we will take a break of 5 minutes. Okay, so please stay motivated and be energetic. If you will start revising group accounts on your own, it might take you the whole day and still you might not get the confidence. But if you revise it from this video, it will become quite easier for you. So please show some energy and stay in the class and watch this class till the end. Okay, all of you. Now to point number 1, consequential impact of fair value adjustment of net assets on date of acquisition. So now what was the fair value impact? Basically 2 things: excess depreciation and reversal of fair value adjustment on inventory. Now standard says that add both of them to the cost of sales. Okay, now if there is a negative fair value adjustment, then there will be savings of depreciation. So if there is a savings of depreciation, then reduce the cost of sales by the amount of savings in depreciation. Okay, so just see, if there is an excess depreciation, means the excess cost, increase the cost. If there is a shortage of depreciation, then you have to decrease costs, then decrease cost of sales. Okay, now fair value adjustment ka reversal, add to cost of sales. Basically the basic essence is whatever is the fair value adjustment, consequential impact of fair value adjustment gets adjusted in the cost of sales. Intra-group trading, if there is an intra-group trading, reduce entire amount, listen to me carefully guys, entire amount of intra-group trading from revenue and cost of sales. Doesn't matter whether the other company has sold it or it remains unsold, irrespective of that. entire amount of intra-group trading which has been done, reduced from revenue, reduced from cost of sales, and the amount of unrealized profit add to the cost of sales. Add the amount of unrealized profit to the cost of sales. Unrealized profit, I believe you know, goods lying unsold multiplied by the profit percentages. Okay, we have already discussed that. Intra-group transfer, add the net amount of unrealized profit to cost of sales or admin expense as the case may be. The question, as the question says. If the question is not saying anything, then you can add it to cost of sales. Okay. Now, what is the meaning of net unrealized profit? It means profit on sale charged by the company who sold the non-current asset minus excess depreciation till date, from the date of transfer till reporting date. From date of transfer till reporting date, what is the amount of excess depreciation? So take that, that will be the net. That will be the net. But understand. Let's suppose I'm taking up an example for you guys. Okay. In this year, the asset was transferred at a profit of 20. Okay. And here, this is the reporting date. The excess depreciation till here is, let's suppose, 3. So what we'll do, we will adjust 17. We'll adjust 17 from cost of sales. We'll add to 17 to the cost of sales. Now, but let's suppose next year the excess depreciation, next year the excess depreciation is, let's suppose, 5. The excess depreciation is 5. Now here what I will do, tell me. Here what I will do. Will I adjust 20 minus 8 is 12? No. So in this year, on reporting date, what I will do is, I will have to reverse this excess depreciation. Means I have to reduce the costs. So I will do minus 5. I will do minus 5 to cost of sales. Is that clear to everyone? So be careful. Ideally, there is no question that is asking from this perspective. Okay. You have questions from this perspective only. Okay. Now, in console P&L I'm talking about, but in console SOFP, if the same question comes in console SOFP, then what will be the treatment? If the same question comes in console SOFP, then what will be the treatment? So then here, this 17 will be adjusted from non-current assets. Okay, adjust 17 from non-current assets. Now, here what I will do, 20 minus 3 minus 5 is how much? 12. 12 will be adjusted from non-current assets. Because SOFP works on cumulative logic. SOFP works on as on date logic. But P&L works for the period logic. Is this concept clear, everyone? Come on, guys, tell me. Okay. Now, intra-group loans. Now, definitely, it will be very easy to explain. From a theoretical perspective. But when it comes to practical discussion of intra-group loans, you have to understand one example properly. I'll discuss that example with you. Don't worry. Okay. Now understand. So basically it says reduce finance income of parent. If parent has given to subsidiary, reduce finance income of parent earned from parent and add back finance cost incurred by subsidiary. Basically eliminate. Again, similarly here also eliminate. But I want to discuss one simple concept with you, which is in the question of Pandar company, in Kaplan. Now it says this is the 1st January, 31st December and 1st of July is the date of acquisition. Okay, this is the date of acquisition. Now, over the entire year, subsidiary has made a profit of 8,000. Subsidiary has earned a profit of 8,000. Okay, now on this date, parent has given a loan to subsidiary, okay, and the finance costs recognized by subsidiary is 2000. Now you have to calculate what is the post acquisition profits. What is the post acquisition profits? Harshita, just hold on, have patience. Let me complete the entire discussion. This concept which you are asking is also in my notes. Okay, I'll discuss that. Don't worry. What is the post acquisition profits? So your post acquisition profits first of all will be 8,000 is the total profit minus 2,000 is entirely post. This 2,000 is entirely post, right? This 2,000 is entirely post. Let's write finance income. Okay. So let me write it this way. Finance income. Finance costs of subsidiary is 8,000. Finance cost of subsidiary is 8,000. Post acquisition finance costs. Okay. Now, so out of this 8,000, 2,000 is entirely post. 2,000 is entirely post. Okay. Now, so this 6,000 comes that accrues evenly over the year. Now I have to do 1 by 2 plus 2,000. This is the post acquisition finance costs. So this is the understanding which you need to have. 3,000 plus 2,000 is 5,000 is the finance costs. 5,000 is the post acquisition finance costs. So while drawing the console P&L, this is how you have to do it off. Now what you will do, this is the post acquisition finance cost. From here you have to eliminate 2,000 finance cost and eliminate 2,000 of finance income from parents investment income. Okay, so this is how. Is that clear, everyone? I will recommend all of you to go and solve Pandar company right after the class if you want to have a grip over the concept of finance intra-group loans. Okay, I will strongly recommend you to solve the question of Pandar company. I have given you a hint of it, what exactly has to be done, but I will recommend all of you, please go and solve the question of Pandar company from Kaplan. Okay. Moving back to my notes. Other adjustment dividend. Now here, since parent has recorded its own share of dividend, so what I will do here, Harshita, now your query gets addressed here. See, reduce parent's share from group finance income. But why are we not reducing anything from subsidiary? Now tell me, subsidiary would have recorded dividend expense where? In P&L? Where will subsidiary record dividend expense? In P&L? No, it is recognized in equity. But we are talking about console P&L. So from the point of view of dividend paid by subsidiary to dividend paid by subsidiary in group P&L, this is the only treatment. Okay, this is the only treatment. You are unable to see the complete picture here. Reason, because it's a P&L. When you prepare SOFP, it is then you see the complete picture of or the complete treatment of dividend paid by subsidiary. In console P&L, you are unable to see the complete treatment, and that's why your query arose, Harshita. ठीक है हर्षिता, आपका ये क्वेरी क्लियर है क्या? आप now dividend paid by parent, so treatment in CFS will be the same as treatment in SFS of parent. If parent company ने अगर SFS में correctly record किया है, if parent company has recognized the dividend paid by parent correctly in SFS of parent, there is no treatment to be done in CFS. Goodwill impairment, whatever is the amount of goodwill impairment, you can add to admin expenses unless otherwise mentioned specifically in the question. If the question says no, you have to add to cost of sales. If the question is silent, you can add it to admin expense and give a note that considering that the impairment loss is recognized in admin expenses. Now, how to prepare console P&L? Prepare console P&L considering the time adjustment. एंड एडजस्टमेंट्स प्रोवाइडेड इन द सेक्शन क्वेश्चन. ठीक है, जो भी क्वेश्चन में एडजस्टमेंट दिया हुआ होगा वो आपको कंसीडर करके इसको कैलकुलेट करना होगा. ठीक है, लाइन बाय लाइन ऐड करते जाओ, लाइन बाय लाइन ऐड करते जाना आपको. ठीक है, नाउ बट टू थिंग्स यू हैव टू टेक केयर ऑफ. एलोकेशन ऑफ प्रॉफिट आफ्टर टैक्स to parent and NCI, allocation of total comprehensive income to parent and NCI, to parent and NCI. Is that clear, everyone? Is that clear, everyone? Okay, now further allocation to oh, just give me a minute. Okay, allocation to NCI. Now understand, as I was telling that the profits earned, total console profit, you have to allocate to parents and to NCI, to parent and to NCI. Now, how to calculate what is the profit attributable to NCI? How to do that? So for that, the standard gives you this one. So standard says that take the entire profit of subsidiary, take the entire profit of subsidiary. I'll take it off just a minute. Take the entire profit of subsidiary, do time adjustment. That's why I've written post acquisition profit. Okay, that's why I've written post acquisition profit. Take time adjustment. Okay, so basically this is what I have done here. From here to here, I have just done time adjustment. Do time adjustment. Then whatever adjustments you have done in the console P&L which impacts solely the profits of subsidiary, which impacts solely the profits of subsidiary. It can be unrealized profit if subsidiary has sold to parent, goodwill impairment if NCI is at fair value, if NCI is at fair value. Okay, now if there is an unrealized profit where parent has sold to subsidiary, is it impacting the profits of subsidiary? No, we are reversing the profits of parent, so that will not come here, that will not come here. Okay, impairment of goodwill. Now Harshita, you were having this query, so let me clarify it here. Finance income or finance cost on intra-group loans will also be adjusted here. Okay, will also be adjusted here. Okay, finance income or finance cost will also be adjusted here. I believe that clears your query, Harshita. This question was there in Pandar company. So this concept again will be cleared in the Pandar company question. So this is all from the perspective of group P&L. I will strongly recommend all of you to solve two questions. Okay, understand. I'm giving you some assignments. Do it off. For console SOFP, definitely solve Dargent company. For console P&L, please solve Pandar company from Kaplan. Okay, and this one McClory company from BPP. Okay, so this is what please solve these questions and this definitely you will get a good hold over the console SOFP and console P&L. Definitely if you have any further queries from that, after that I will be there to help you out. I will try my level best to help you out with that. But yes, please solve these questions at least today itself so that you'll get the complete grip over all the concepts that we have discussed so far. Now, we are starting with a new topic, that is acquisitions and disposals. But before that, we'll take a 5 minutes break so that you also can relax yourself, rejuvenate your energy, and then we'll start afresh with new energy and new juice. Is that clear, everyone? So let's take a break of 5 minutes and then resume back. We will wrap up this session by 10 p.m. around. Okay, we'll wrap up this session by 10 p.m. around. आ जाओ गाइस, स्टार्ट करते हैं. लेट्स स्टार्ट इट विथ न्यू जोश. ऑडियो वीडियो क्लियर है क्या? कंफर्म करो फटाफट फटाफट फटाफट. ऑडियो वीडियो क्लियर है गाइस? कम ऑन गाइस, टेल मी, ऑडियो वीडियो क्लियर है क्या? ऑडियो और वीडियो. एम आई ऑडिबल? हेलो, थैंक्स अमन. ओके, स्टार्ट करते हैं. ग्रुप अकाउंटिंग एक्विजिशंस एंड डिस्पोजल्स. ठीक है नाउ, तो इसमें हमें दो चीज पढ़ना है, स्टेप एक्विजिशन और ग्रुप डिस्पोजल्स. ठीक है नाउ, स्टेप एक्विजिशन के लिए बेसिकली यहां पे इतना सा बोल रहा है कि अगर जब भी आप स्टेप एक्विजिशन कर रहे हो, मतलब यहां पे क्या हो रहा है, आप ले रहे हो 45% आपका होल्डिंग था, आपका 45% था, आपका 45% था, आप इसको बढ़ा के 60% पे चले गए. आप बढ़ा के 60% चले गए, मतलब आपका कंट्रोल अचीव हो गया. आपका कंट्रोल अचीव हो गया. आपका कंट्रोल अचीव हो गया. नाउ जैसे ही कंट्रोल अचीव हुआ, बोला यहां पे क्या बोल रहा है, बस देखो इसमें कुछ भी अलग से मैं नहीं पढ़ा रहा हूं, बस आपको एक पॉइंट पढ़ाना है मुझे इसमें, बस एक पॉइंट. जैसे ही कंट्रोल अचीव हुआ तो अब क्या हो रहा है यहां पे, देखो ऐसा है क्या. नाउ इज इट द थिंग दैट वी हैव अक्वायर्ड दिस एंटायर 60% इन वन गो? नो, वी हैव अक्वायर्ड इन स्टेजेस. अर्लियर वी अक्वायर्ड 40%, नाउ अगेन वी अक्वायर्ड 20% एंड इट बिकम्स 60%. सो इट इज कॉल्ड एज स्टेप एक्विजिशन, स्टेप बाय स्टेप, tick tick tick, right, step by step. So now in this case of step acquisition, when we are calculating goodwill, now how to calculate goodwill? Investments plus NCI minus net assets, right? Now when I'm taking the investments, so investments may it will come two things: 45% investment which I acquired some time back, 15% investment which I acquired now, 15% investment which I acquired now. Now understand, will that be logical to compare while calculating goodwill? Will that be logical to compare the net assets of today versus the cost of investment of some time back versus the cost of investments of some time back? Will that be logical? No. So standard says that the investment, the previously acquired interest of 45%, please revalue to the current date of acquisition, and any gain or loss on this revaluation is recognized in consol P&L. Is recognized in consol P&L. That's the treatment. That's the only thing which you need to keep in mind. Okay. Now loss of control, which is also called as group disposals, now we have to be careful here. In case of group disposals, be very careful here that, tell me, when we acquire a subsidiary, what is the entry we pass? We recognize the assets of subsidiary, we recognize the liabilities of subsidiary. Basically we recognize the net assets of subsidiary, we recognize the NCI, we recognize the goodwill, we de-recognize investments, right? Now you have to do just the reverse. You have to de-recognize net assets, you have to de-recognize NCI, you have to de-recognize goodwill, and all these value on the date of disposal. De-recognize, recognize the sale proceeds, any difference is called as gain or loss on disposal. Okay, is called as gain or loss on disposal. ठीक है, step acquisition, there was only one question, you can ignore it off. No, there is no point, there is no challenge. Just one small point keep in mind. Okay, just one small point can come in the exam in the rest of situation. Keep in mind, just keep in mind. Okay, just keep in mind. Now loss of control. Okay, now whether it is full disposal or partial disposal, the treatment remains the same. Okay, so de-recognize net assets on the date of loss of control, or we say on the date of disposal, goodwill on the date of disposal, de-recognize NCI on date of disposal. Now you know what is the examining team saying about this? Examining team mentions that whenever we ask to calculate the gain or loss in SFS of parent, then also the students are calculating the gain or loss in this manner, which is wrong. So please read the question carefully. Please read the question carefully. Let me explain what I'm trying to say. Let's suppose you acquired a investment for 200 here. Cost was 200 for investments. In SFS, you recorded it at cost. Okay. Now, the net assets of subsidiary was, let's suppose 180. Okay. And hence you recognized goodwill of 20. Okay, now here the net assets of subsidiary became 250. Okay, and goodwill remains at 20 itself. And now you sold the asset, you sold the investments for 300. Now, so what happens in SFS? What is the gain or loss which you record? So in SFS, you will compare this with this. So you will record a gain of 100. In SFS, you will record a gain of 100. But in CFS, what will you do? You will de-recognize this one. Sorry, you will, sorry, my bad. You will de-recognize this one. You will recognize this one, and any gain or loss will be called as that one. So what will you do? In CFS, you will say, you will de-recognize this much. You will recognize this much means you will recognize 30 ka gain. In CFS, you will recognize 30 ka gain. In CFS, this is happening in CFS and this is happening in SFS. Now the standard is saying that even if the examining team is saying, even if we are asking for SFS, a student are giving us the answer for CFS. So be careful, guys. Read the question carefully. Read the question carefully. If they are asking for SFS or CFS, read the question carefully. If they are asking for SFS or CFS, is that clear, everyone? Is that clear, everyone? Now, if there is a partial disposal, means there was, let's suppose I had a subsidiary wherein I had 60% holding. Okay, I sold, let's suppose 50% holding, and 10% holding is still with me. Now it says, standard says that if you have some holding with you, so that retained investments should be measured at fair value on date of disposal. So journal entry becomes what? Bank account debit, sale proceeds. NCI account debit, okay, the value on date of disposal. Investments retained account debit, fair value on date of disposal. To goodwill, to net assets. Now, whatever is the difference will be called as gain or loss on date of disposal. Okay, gain or loss on date of disposal, gain or loss on disposal. But this gain or loss on disposal will be in CFS. In SFS, it's simple. The carrying amount versus the sale proceeds is the gain or loss in SFS. Okay. Yes, so this gain or loss on disposal, if you are preparing console SOFP, then you have to add to group RE. If you are preparing console P&L, then you have to record it separately. Is that clear, everyone? Now this is all about the group disposals, and group disposals has been a favorite topic of examiner in section A. Group disposal has been a favorite topic of examiner in section A and section C both. You want to see? Group disposal has been a favorite topic of examiner. Do you want me to prove that? Group disposal has been a favorite topic of examiner. Let me prove it off. See, group interpretation, sale of subsidy, group disposal, sale of subsidy, group disposal, sale of subsidy, group disposal. 1, 2, 3, 4, 5, 6, 7, 8. Now, okay, how many times a question of group accounts had come? See, out of 8, 3 times, it's the same question, group disposal. Out of 8 times, same question of group disposal. So now you understand this is the very favorite topic of examiner. Is that clear to everyone till here? Is that clear to everyone till here? Come on, guys, respond fast. We have to discuss the mistakes highlighted by the examining team. We have to solve questions. We have to do many things. Come on, guys. Okay, coming to part 5 of associates. Now, for associates, there has to be a significant influence. Okay, but before going to see associates, let us go to index and see what we have studied and what is pending. Okay, let us go to index a little bit. Okay, we have studied the console SOFP basic procedure, fair value of net assets. We have discussed the other adjustments also. We have discussed mid-year acquisition, from where statement of net assets addresses the mid-year acquisitions. Statement of net assets addresses the mid-year acquisition concept. We have discussed the basic procedure. We have discussed other adjustments. We have discussed allocation of to NCI. We have discussed mid-year acquisitions. Okay, how multiplied by time adjustment is called as mid-year acquisition. Changes in group structure, we have discussed step acquisition, we have discussed group disposals. Associates, we are yet to discuss. Now see, we have discussed almost everything of group accounts. Now tell me, are you getting the confidence on the group accounts? Are you getting confidence in the group accounts? Please tell important questions of group disposal. Buddy, understand, I have already told you the important questions of group disposal. How, see here, what you have to do. As September-December 2023 paper, this is there in ACCA practice platform. Go and solve it. March-June 2023, not March, sorry, September-December 21, this is there in ACCA practice platform. Go and solve it. So you have 2 questions. And Macquarie Company, Harshita mentioned, Macquarie Company, wonderful question, Macquarie Company. Go and solve it. Macquarie Company you will find in BPP. I'm not sure if Macquarie Company is there in Kaplan or not, but it is there in BPP. Okay. Now, associates. So associate means what? Significant influence. Now, what is the meaning of significant influence? Let's discuss the meaning of significant influence now itself. So see, understand, or basically I'll discuss it from this perspective. What exactly is the difference between control and significant influence? What exactly is the difference between control and significant influence? Control means I have the power to take decisions. Significant influence means I don't have the power to take decisions. I can participate in decision making, but I don't have the power to take decisions. Okay, I don't have the power to take decisions. Now, so that's the difference between control and significant influence. To give an example, in the board of directors, there are 8 directors, and out of which 6 directors are appointed by me. Now, if any decision has to be taken, don't you think I can take any decision? Right? Because majority of the directors are appointed by me, so I have the control over the company. But in the board of directors, only one director is appointed by me. So can one director take the decisions? No. Definitely he can participate. He will have a say in the meeting, but he cannot take decisions. So that's called significant influence. Okay. Okay. Let me give one more example. Now, these days, we hear a term social media influencers a lot, right? Now tell me, these influencers, do they control you? No, but they can influence your decisions. They can participate in your decision making, but they can't control. They can't come and say, no, you have to purchase this product. Any social media influencer can't come to Sonali and say that, Sonali, you have to purchase this product for sure. No, they will just participate in decision making by telling the advantages or disadvantage of that product. That's why we call them influencer. We don't call them controller. We call them influencer. They can influence, they can participate, but they can't take decisions. Okay, they don't have the power to take decisions. Whenever we have control, we have the power to take decisions. Like for example, our parents, they can take decisions for us. They control us. Okay, so it says voting power of 20% or more is default. By default, we'll assume it is significant influence exists, but Ideally, significant influence means power to participate in financial and operating decisions of the company. Okay, and where are financial and operating decisions taken? Board of directors. Board of directors takes financial and operating decisions of the company. Now, accounting treatment in SFS of the parent. In SFS of the parent, this investment, not joint venture. In SFS of the parent, this investment in associate can be recorded at its cost or fair value. Okay, as the case may be. But in console FS, we follow equity method. Now, what is the meaning of equity method? So, equity method means investment in associate at cost. Now, you will add the post acquisition changes in the net assets. You will add the post acquisition changes in the net assets multiplied by associate ka holding percentage. Now, whatever is the profit earned from date of acquisition till reporting date multiplied by associate holding percent. If associate, now understand what is the meaning, what does this balance of investment in associate represents? The amount that I expect to recover from the associate company, the amount that I expect to recover from the associate company. Now, if I have already received something from the associate company, I will reduce my investment in associate. Okay, I will reduce my investment in associate. So, if I have received something from associate company in the form of dividend, it will reduce my investment in associate. If you have impaired the investment, then impairment loss also. Now, unrealized profit. If unrealized profit on intra-group trading I'm talking about, okay, but be careful, only if it is parent to associate. If it is associate to parent, no, it won't come here. 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 Okay, it won't come here. It won't come here. Only if it is parent to associate, it will come here. Otherwise, it won't come here. Why? I will discuss the reason why also. See here. If it is associate to parent, now who has earned the profit? Associate. So let's reduce the profit of associate. Who has the inventory? Parent. So let's reduce the inventory. So post acquisition profits of associate account debit to inventory. Now, if parent has sold to inventory, who has earned the profit? Parent. So let's reduce the profit of parent. Now, who has the inventory? Associate. Are we recording the inventory of associate in my console SOFP? Tell me, are we recording the inventory of associate in my console SOFP? No. So that's the reason I have to do investment in associate. In our book, many places, there is still a mistake. Okay. So please be careful that this is the right approach. This is the right approach. This is the right approach of solving it off. Okay. So basically what I want to say, if the unrealized profit is between parent to associate, then you have to do adjustment in investment in associate. Otherwise, no. I believe this adjustment is clear to all of you. Do not make this mistake, because why I'm telling you again and again not to make this mistake is there are mistakes still done in your exam kit of Kaplan and BPP both. Okay, so please be careful. Even if there is a mistake there, ignore that. This is the correct treatment which you have to follow for the exam. Okay, now if the associate has sold to parent, basically what you have to do, first of all, calculate the unrealized profit. Unrealized profit matlab, what is the meaning of unrealized profit? Profit on unsold goods. Profit on unsold goods multiplied by associate ka holding percentage. Do not forget to multiply associate ka holding percentage. Okay, now what is the treatment in console SOFP for both of them? Console SOFP. So basically for this one, you will reduce inventory by unrealized profit and reduce group RE by unrealized profit. Okay, now this one, what will you do in console SOFP? Reduce, same thing will come here. Copy, paste. But understand, here it will not be inventory. Here the only changes here, it will be investment in associate by URP. Is that clear, everyone? Is that clear, everyone? Now in console P&L, what will you do? In console P&L, what will you do? Add the unrealized profit. See, now it is associate has sold to parent. So who has earned the profit? You have to reduce the profit of this one. So what you have to do? You have to reduce share of profit of associate. And in P&L, what will you do? Add unrealized profit to cost of sales. So this is the treatment in P&L and SOFP. I believe it is very much clear to all of you. I believe it is very much clear to all of you. Is that clear, everyone? Come on, guys, tell me. Is that clear, everyone? Till here? Okay. Now, part 6, that is the theory. Most important, there are a lot of theory questions which student makes mistake in the exam, and I don't want you to make this mistake in the exam. Okay. So let us discuss these theory questions also. What is the meaning of business combination? Okay. Business combination means a transaction where the acquirer obtains control over the business of another company. Now we have to understand the meaning of control. Now control basically means three things. Control basically means three things: power over investee, rights or exposure to variable returns, and ability to exercise its power to affect the returns. Now, what is the meaning of these three? Let us discuss it one by one. Power over investee means power to take relevant decisions, power to take relevant operating and financial decisions, power to take decisions which most significantly affect the returns of subsidiary. And how will it come? Either from contractual rights or from voting rights. If it is from contractual rights, by virtue of a contract, I do have the power to take decisions. If it is from voting rights, then if I have majority voting rights, then I have power over investee. If I have minority voting rights and the other investors, they are widespread, not connected, not actively participating, then I have the power over investee. Okay, right or exposure to variable returns. Now, if I have the power over investee, I should be impacted by the decisions which I make. If I have made a good decision, I should have the right to returns. If I have made a bad decision, I should be exposed to the losses. Now, ability to exercise power. Now, I should have the ability to affect my power over the investee to take the decisions which can affect my returns. Basically, it is talking from the point of view of principal versus agent. In my classes, I take an example of Sundar Pichai. Sundar Pichai has the power to take decisions of Google, all the operating and the financial decisions. Okay, Sundar Pichai can affect, Sundar Pichai is exposed to variable returns. But is Sundar Pichai the principal or the agent? Sundar Pichai is not the principal. He is the agent of the founder of Google, Larry Page. Okay, so Sundar Pichai is not having the control of Google. Sundar Pichai is not having the control of Google. Okay, he is just an agent acting on behalf of founders of the Google. If at any particular day Sundar Pichai takes a decision which is not in line, with the thought process of the founders of Google, then founders of the Google may fire him off. Okay, may fire him off. That's the meaning of control. Now, what's the meaning of measurement period concept? What's the meaning of measurement period concept? So, measurement period concept basically means on the date of acquisition, when I am acquiring the control over the subsidiary, it might not be possible for the entities to calculate the fair value of the net assets on date of acquisition on that specific date itself. Okay, then standard gives you a window of 1 year. Okay, standard says that within 1 year you can calculate the fair values on date of acquisition. Okay, now understand. If this is the date of acquisition, this is the 1 year ending, this is beyond 1 year. If any new information becomes available regarding fair value of assets and liabilities, and this information existed on date of acquisition, okay, just that I was not aware of it, but it existed on date of acquisition. Might be I was not aware of it. Okay, then the standard says that if that is the case, this will impact your NCI, this will impact the fair value of net assets, this will impact your NCI, this will impact your consequential goodwill, But These facts or information which becomes available after date of acquisition, and these facts and circumstances didn't exist on date of acquisition. It arose subsequently. It arose subsequently. Standard says that if it arose subsequently, then in that case we will not change the value of goodwill. Or if any facts or circumstances we are becoming aware of any facts or circumstances beyond 1 year, even if it is existed on date of acquisition, okay, then we can't change the value of goodwill. Max to max we can wait till 1 year. If after 1 year you are saying, sir, we become aware of any information which existed on date of acquisition, fine, I'm not considering that, I'm not changing my goodwill for that, okay, till 1 year, max till 1 year, if any information becomes available to me which existed on date of acquisition, we change the value of goodwill, otherwise the goodwill value will not change. Uniform accounting policies. Basically, it says the accounting policies of the parent and the subsidiary and the entire group companies should be uniform. If it is not uniform, then the accounting policies of subsidiary should be made in line with that of the group. Okay, so we have to do the adjustments to make the accounting policies uniform. What is the meaning of uniform accounting policies? So basically, let's suppose for a building, parent is following cost method, but subsidiary is following fair value method. Now, what we have to do? So subsidiary is also required to switch to cost method when we are preparing the consol FS. Okay, so the policy should be the same entire group. For the entire group, the policy should be the same. Different reporting dates. It says, let's suppose parent is having a reporting date of 31st December, but subsidiary is having a reporting date of let's suppose 30th September. Different reporting dates. It says if the gap is for 3 months, difference up to 3 months, then what does it say? Consider latest FS. जो भी whatever is the latest financial statements available with me, okay, I will consider that FS and do the consolidation, do the group accounting. But if the difference is more than 3 months, then the standard says that the subsidiary company has to prepare financial statements on the reporting date of the parent and give the financial statements to the parent for consolidation or for preparing group accounting. Okay, prepare FS of investee as on the reporting date of the parent. Exemption from group financial statement. There are few cases wherein the preparation from the group accounts is exempted. What are the cases? It says entity is wholly owned or partly owned subsidiary of another entity. This entity is having one more parent. This entity is having a parent company. Okay, and all the owners of the entity are informed and they do not object. बोल रहे हैं यहाँ पे हमने सारे ओनर्स को इन्फॉर्म कर दिया है कि हम लोग कंसोल नहीं बना रहे हैं एंड उनको कोई ऑब्जेक्शन नहीं है, ठीक है. नाउ या फिर हमारा डेट या इक्विटी इंस्ट्रूमेंट्स लिस्टेड नहीं है, दे आर नॉट लिस्टेड, नाइदर दे आर लिस्टेड नॉर दे आर इन द प्रोसेस ऑफ लिस्टिंग. Okay, not traded in public market. Okay, neither listed nor in the process of listing. Okay, neither listed nor it is in the process of listing. Okay, now it says further, entity's ultimate parent company, ultimate or intermediate parent produces finances that are available for public use and comply with IAS or IFRS in which subsidiaries are consolidated. Basically, it says that I have a parent company who prepares consol FS. If that's the case, yes, I am exempt. Let's suppose I have subsidiaries. I'll tell you this one. Subsidiary SS1, SS2, SS3. So it says that if this company is preparing consol FS, then this company is exempt from preparing consol FS. Okay, this company is exempt from preparing consol FS. So this is all about the group accounts. Now I will go on to the mistakes which the examining team has highlighted for you guys. Okay, so let us discuss the mistakes now. Now in mistakes, what is it saying? So it says mistakes to be avoided. Please listen carefully, all of you. Do not get confused in the exam. If the exam uses a term such as full goodwill or partial goodwill, NCI at fair value method sometimes be referred as full goodwill, and NCI at proportionate share method may sometimes be referred to as partial goodwill. We have already discussed in the class. Okay, calculate fair value of non-controlling interest at FVM properly. If fair value is not given in the question, calculate using number of shares held by NCI multiplied by fair value per share of subsidiary. Do not take fair value per share of parent. Do not take fair value per share of the parent. This was a mistake done by multiple students. Do not take 100% share of subsidiary. Why? Because NCI is not having 100%. NCI is not having 100% shares of subsidiary. NCI might have certain percentage of shares. So take only that percentage. Or do not take holding percentage of the parent. Don't take. So B, take what is the number of shares of subsidiary. What is the number of shares held by NCI multiplied by what is the fair value per share of the subsidiary company. This is how you will calculate the fair value of NCI. Again, fair value adjustment of net assets of subsidiary on date of acquisition is adjusted with goodwill. However, so it says, Harshita, your point is coming up here. Harshita, your point is coming up here. It says, if you are doing any fair value adjustment on date of acquisition, that will impact goodwill. If you are doing any fair value adjustment, on date of acquisition, it will impact goodwill. If you are doing any fair value adjustment subsequent to date of acquisition, it will not impact goodwill. Rather, it will be accounted for as per respective standards. Let me take up example. Let's suppose if there is a fair value gain or loss on account of PPE on date of acquisition, so it will impact goodwill. But subsequently, we will record revaluation gain or loss. We will record revaluation gain or loss in OCI. Let's suppose there is a fair value adjustment on account of investment property subsequently, it will go to P&L. Let's suppose there is a fair value gain or loss on account of investment in equity instruments at FBT OCI, it will go to OCI. So subsequently as per the respective standards. Now, if there is any fair value gain or loss of net assets of parent company, tell me, will that impact goodwill? Will that impact goodwill? If there is any fair value gain or loss of net assets of parent company, will that impact goodwill? Will that impact goodwill? No, it won't impact goodwill. It won't impact goodwill. Okay, it won't impact goodwill. It will be accounted as per the respective standards. Because while calculating goodwill, we are comparing the investments versus the net assets of subsidiary, not parent. Okay, so that's what it says. Fair value adjustment of net assets of subsidiary on date of acquisition is adjusted with goodwill. However, any fair value adjustment of net assets of subsidiary after date of acquisition is treated in line with respective standards. Further, any fair value adjustment of net assets of parent, whether on date of acquisition or after date of acquisition, is treated in line with respective standards. Now, again, loan issued as part of purchase consideration. Loan issued as part of purchase consideration is different from intra-group loans. There are times you get confused. Loans issued as part of purchase consideration is different from intra-group loans. Why? Because in intra-group loans, parent is giving the loan to subsidiary or subsidiary is giving the loan to parent. But in loans issued as part of purchase consideration, the loans are given to shareholders of subsidiary. This is not intra-group. Okay, issue cost on acquisition will be recognized in P&L and do not add to the cost of investment. Markup is on cost and margin is on selling price. I have explained this with the help of example also. Group SOFP, take 100% of net assets of subsidiary. Even if the holding is 100%, 80%, 55%, whatever is the holding, I have acquired 55%, still I will take 100% of the assets of subsidiary. I have acquired 70%, still I will take 100% of the assets and liabilities of the subsidiary. Do not, please understand the control. We have the control over the entire assets and liabilities of subsidiary. The control is not in percentages. The control is either yes or no. Reduce finance cost on unwinding of deferred consideration from group RE and simultaneously adjust deferred consideration. Adjust fair value changes on contingent consideration from group RE and simultaneously adjust contingent consideration. Guys, these are the commonly made mistakes which all of you have done it sometime or the another. Okay, so please guys, I sincerely request you at least with this class, please, with this class, whatever points I have told in this class, make a note that you are not making any other, these mistakes at least you are not making in the exam. If you want to make any new mistakes in the exam, you can do it, but at least not these mistakes. And I assure you, if you take control of the mistakes which I have discussed in the class today, you won't be doing any new mistake because there are no other mistakes which you can do other than plus or minus mistake which you can do. Okay, now mid-year acquisition. Mid-year acquisition, if it is there, then we have to do time adjustment in group P&L. In group P&L, you have to do time adjustment. You have to do time adjustment in group P&L. Not in group SOFP. Not in group SOFP. Not in group SOFP. Mid-year acquisitions, profit is time apportioned, but not dividend. Dividends are not time apportioned, my friend. Dividends are not time apportioned. Only the profits are time apportioned. Profits, we have to do time adjustment, but not dividend. Dividend is fully post. Dividend is fully post. Mid-year acquisition, excess depreciation on fair value adjustment also needs to be time apportioned. Okay, fair value adjustment का excess depreciation को भी time adjustment करना पड़ेगा आपको. Now, be careful while eliminating finance income with finance costs of intra-group loans in case of mid-year acquisition. A subsidiary's counterpart is wholly post. मैंने ये वाला पढ़ाया था आपको अभी. I discussed that with you. Pandar company. Group P&L. Group P&L. Do not forget to split the profit. That is profit for the year, profit after the tax, and total comprehensive income to parent and NCI. Trust me, in all the examiner reports, examining team has mentioned this point that the students forget to allocate the total console profit to parent and NCI. You have to show this allocation in console P&L, group P&L. You have to show this allocation. Now, group P&L. Do not adjust subsidiary P&L for holding percentages. I discussed it here. When you are preparing group P&L, so subsidiary you have to do time adjustment, but subsidiary you don't to adjust for that holding percentages. No, see, I've discussed it here. Don't adjust it for holding percentages. Don't adjust it for holding percentages. While allocating the profit to parent and NCI, do not just proportionately allocate, rather calculate. Okay. Now what happens here? What students does is, so they calculate what is the parent ka profit, what is the subsidiary ka profit into time adjustment. Now let's suppose some X figure comes up. So what they do, X ka 80% is for the parent and 20% is for NCI. This is wrong. This is a blunder. Understand what is happening. Now what you are saying. Now NCI will get the share of the profits of parent also. Is it the case? NCI will get the share of profit and by parent also? No. NCI can get 20% of this. Not this. So do not allocate this 80-20. No, this is wrong. While allocating profit to parent and NCI, do not just proportionately allocate. No. Rather, calculate the profit attributable to NCI and the rest is for parent and the rest is of parent. Reduce only parent share of dividend from the subsidiary from investment income. Harshita, your query. Okay, reduce only parent share of dividend from the group P&L, investment income. Okay, further for dividend paid by parent, there is no treatment in group P&L. Now, group disposals. Read the question carefully. See, read question carefully. If gain or loss is asked in SFS of parent or group FS. I told this, right? If the question is silent, then calculate in group FS. Now, while calculating gain or loss on disposal in group P&L, compare sale proceeds with values of net assets, non-controlling interest and goodwill on date of disposal. Okay, sale proceeds on date of disposal versus net assets, NCI, goodwill on date of disposal. Compare these two and calculate the gain or loss on disposal in group FS. Now, acquisition of associate by way of share exchange. Fair value of share exchange becomes the cost of investment in associate. I believe you are understanding these mistakes. Unrealized profit. Parent to associate. If it is parent to associate, then you have to impact console P&L and investment in associate. If it is associate to parent, as I was discussing, it will impact post-acquisition profits of associate and inventory in group SOFP And also the standard examining team told that they have identified that group P&L is a weak area. they have identified that group P&L is a weak area. Now, once they have identified that group P&L is a weak area of the students, now you see what they are trying to do. See what they are trying to do. They are asking group P&L. They are asking group P&L. They are asking group P&L. They are not asking group SOFP. They're not asking only. They're asking group P&L. So what does it mean? We have to practice group P&L a lot. We have to practice group P&L a lot. We have to practice group P&L a lot. Now, how to do the practice now? How to do the practice now? So for that, the plan is, see, today we have revised the entire group accounts. Okay. Tomorrow, I have identified the questions which I've identified. See these questions, the ones which I've identified. Okay. So what I will do tomorrow, I will discuss some section A past paper important questions. Plus pre-mock June 2024, pre-mock June 2024, there is a question on group P&L. There is a question on group P&L. I will discuss this question on group P&L because group P&L is a weak area. I will discuss that with you guys. And fate has favored us. Okay. The question on pre-mock June 2024 is about group P&L only. So we'll discuss this question also with you guys tomorrow. Is that clear, everyone? So tomorrow, same time, 7 p.m. We will sit and discuss these questions. Okay. These questions. So tomorrow will be focused on the practice. Today we focused on the concepts. I believe you have got the grip over all the concepts of the group accounting. Tell me yes or no. The session gave you a grip over all the concepts of group accounting. Right. So now that's all for the day, guys. I hope you enjoyed the session. If you have not liked this video, so I sincerely request you like this video and subscribe the channel. Also after the session ends, I will request all of you to drop a feedback. It will motivate me as well. Okay. You have to keep motivated me. So drop a feedback in the comment box or whatever is the feedback. If you want any other help, please drop that also in the comment box. I will definitely read your comment and try to help you out in the best possible manner. That's all for the day, guys. Thank you. Bye.